Hi, and congratulations on your new position. My name is Corey Rowland, and I'm the Member Services Manager at Kern County Employees Retirement Association. Today, I will go over some retirement information you need to know during your career. This information will help you plan, prepare, and save for your financial future. Kern County Employees Retirement Association, also known as KCERA, is your retirement plan. KCERA is a defined benefit plan, not a defined contribution plan. What that means is, as a defined benefit plan, your contributions are mandatory. A defined contribution plan is like a deferred comp or a 401k plan where you can choose if you want to participate and choose how much to contribute. The benefit of KCERA is your retirement is not defined by your contributions. Instead, it is based on specific factors: your years of service, your age at retirement, your highest average compensation, your benefit tier. Once you become eligible to draw your retirement, also known as a pension, it will pay you for the rest of your life. Unlike a 401k, you do not have to worry about outliving a pension. Membership into KCERA is automatic upon appointment to a permanent position with 40 hours or more in a pay period. Once you become a member, the contributions are mandatory. Your entry into KCERA can be 1 day up to 2 weeks. We call that the waiting period. That period is purchasable because you did not make any contributions during that time. If you go to our website, kcera.org, you can run an estimate in your member portal to see what that would cost. You should receive your welcome letter from KCERA in the first couple weeks of your employment. That welcome letter contains your member key. Once you receive your member key, please visit our website and register for your member portal. The member portal is an excellent tool that allows you to see your retirement, run estimates, and much more. It's a great way to help you plan for your future. There are 2 types of memberships at KCERA: safety and general. Safety members are sworn officers, sheriff, and firefighters. The rest of us are general members. Contributions into KCERA are mandatory, they are pre-taxed and deducted biweekly. Unlike a 401k or deferred comp, you cannot borrow from your KCERA account. It is not a liquid asset. The only way to withdraw your funds from KCERA is upon termination of your employment. Once you terminate, you can withdraw your funds and forego the pension that you could be eligible for in the future. Your contribution rate is based on your tier and could be based on your age, but most new employees, it will be based on a flat rate. When you log on to your member portal, it will give you your contribution rate. Your rate will be based on your base salary and any special pensionable pays you may be receiving. So how does it work? How do you get service credit every biweekly or every pay period? Your contribution is automatically deducted from your check, and you get retirement service credit for that pay period. Every biweekly is 0.0383. That sounds like a small amount, but over time it builds up. If at some point in your career you do go out on a leave without pay and you do not receive a paycheck, you are not making contributions into KCERA, and therefore you will not receive service credit for that biweekly. Those contributions you missed while you were out on leave may be purchasable, and I will go over that in a few minutes. First, I want to talk about one of your most important milestones, your 5-year mark. Once you hit your 5-year mark, you are vested in KCERA. If you were to change jobs to the private sector or move out of state to another job, you could leave your funds on deposit with KCERA and start drawing your retirement once you become eligible. That benefit would be paid to you for the rest of your life. The 5-year vesting is an important milestone. If you previously had per diem service, extra help time, or temporary employment, you could purchase that time. Any purchases you make goes towards your vesting. If you previously worked for the county and withdrew those funds when you left, you can redeposit those funds. Redeposit options are important to look at as they could change your tier. When you purchase per diem service, extra help time, temporary employment, medical leaves, or your waiting period, those purchases go towards your eligibility for retirement and vesting, and therefore would increase the pension you would get. One thing to note, when purchasing service credit, waiting can cost you. Every 6 months, interest is added. That means that every 6 months, that time becomes more expensive to purchase. So procrastination is not your friend. There are a variety of options available to make those purchases and redeposits. You can make a lump sum payment, do a payroll deduction and spread it out over time, or utilize a deferred comp rollover and go from a tax-free account to a tax-free account. That is a great option for a purchase. Another type of purchase available is PPS, prior public service. This could be prior military service and is also available for federal or governmental workers. If you do not have funds on deposit with them, that time may be purchasable with KCERA. You can log on to your member portal and run an estimate to see what that would cost. These types of purchases do not go towards your vesting, but would increase your pension. No matter the type of service you purchase, it will only go towards your KCERA benefit. It will not enhance any other benefits with your employer. It does not increase your vacation, seniority, health benefits, or any other benefits. It only goes towards your retirement calculation. Another benefit that could enhance your retirement is reciprocity. Reciprocity is a link between one California governmental agency and another. If you previously worked for the state, other California counties, or most other California governmental agencies, you may be able to establish reciprocity. You must have started your employment within 6 months of terminating your previous employment, and you cannot have any overlap. You must be completely terminated from them before you start your new job. You can also establish reciprocity if, in the future, your career takes you to a different California agency. You would need to leave your funds on deposit with KSARA. The same time rules apply. Start your new job within 6 months of terminating your previous one with no overlap. The benefit of reciprocity is when you get ready to retire, both agencies share your salary. Whichever agency has the highest average salary is the one used for both systems when calculating your pension. Another great benefit of reciprocity is that your combined years of service determine your eligibility to retire. You will get 2 retirement checks, one from each system, based on your years of service in that system. One of the questions we get asked most often, and I know you're thinking it right now, when can I retire? Once you have 10 years of service credit, and that includes reciprocity and purchased service, and reach a minimum age of 50 or 70, regardless of your years of service, you can start receiving a benefit. For safety members, you can retire once you have 20 years of service credit, regardless of age. For general members, 30 years of service credit, regardless of age. The benefit tiers are another important factor in calculating your pension. Most everyone today will be Tier 2 PEPRA because you were hired after January 1st of 2013. For general Tier 2 PEPRA, you're going to be at 1.62% at 65. For Legacy Tier 2, you are the same, but there are additional special pays that are pensionable. You can find a list of these special pays that are included on our website. Another difference between the 2 tiers is what salary is going to be used to determine your final average compensation. PEPRA is your highest 3-year average compensation, while Legacy is your highest 12-month average compensation. When you register for your member portal account, you'll be able to see your average compensation and your pensionable special pays. The member portal is a great tool to help you with your planning. Also on our website, you'll be able to look at the percent of final compensation matrix. There's a matrix for every membership tier, Tier 1, Tier 2, for both general and safety. Here you can see the full matrix for general Tier 2. This matrix shows your percent of final compensation for that tier. On the left column, you can see the years of service, and along the top is the member's age. If you match the column with the row, you can see the percent of compensation for that age and years of service combination. On top of that, for our general Tier 2 members employed by the county, you are getting a 6% premium pay, and they are offering you a 6% match into deferred comp. That's 12% of your salary into your Voya deferred comp account. That is a fantastic benefit to pair with your pension. Now, what happens when you end your employment before reaching retirement eligibility? When you terminate your employment with your employer, you have several options regarding your accumulated retirement contributions. You can leave your funds on deposit at KSARA, and if you are vested with 5 or more years of service, you can receive your pension once you become eligible. For deferred, non-vested members, you can keep your contribution balance in KSARA, where it will accrue interest over time. However, you are not entitled to a future retirement benefit and must eventually withdraw your funds. Refund or rollover. KSARA can issue a lump sum payment, refund, or transfer your contribution balance to a qualified retirement account, rollover. Taxes and early withdrawal penalties may apply to refunds. There's a 30-day waiting period before your withdrawal request can be processed. Once the funds are dispersed, your KSARA membership ends. Establish reciprocity. You can establish reciprocity with an eligible retirement agency in California, but specific rules apply. Throughout your career, we urge you to keep your beneficiaries up to date. There are substantial survivorship benefits even for active members. If you pass away, your contributions and the accrued interest must be paid out to the appropriate person. California is a community property state. If you are married, your spouse must be named your primary beneficiary, and your pension is considered community property. If during your career you find yourself unfortunately dealing with a divorce, you need to contact KSARA and make sure that your pension is addressed in your divorce. You can have our legal staff look at your divorce documents so that you can make sure that your KSARA benefit is addressed appropriately. There may be additional documents required. KSARA cannot place you on retirement payroll, distribute refund or rollovers until all the documents have been received and approved by the KSARA legal team. Please take a moment to visit our website at ksara.org to learn more about your pension. While you are there, register for your member portal account and make sure to bookmark our page. From everyone at Kyocera, congratulations on your new career. We look forward to working with you and helping you plan and prepare for your future. Thank you.